are literally shaping the planet.
Purpose is the only pathway to a regenerative future.
We have a choice to stay with the status quo or to change.
What is the point of trying to be just resilient when we can actually innovate?
Thank you to the Shadow Ventures team for having us, as well as Habitat for Humanity Terwilliger Center for inviting us to speak. I've gotten to see a couple of those sessions, so the conference is great. I thought, we're going to get into impact investing in housing innovations, like you mentioned, and really try to draw some lessons and some experience from Arun that has he's been working in fields outside of real estate. But I thought I'd give a little bit of background and some context for the discussion. Me personally, I come from a family of entrepreneurial real estate nerds. I grew up on job sites. I love building financial pro formas, and I'm always looking for ways to push the boundaries within the slow changing real estate industry. Prior to starting Global Urban Village recently, I was a portfolio manager for some large apartment projects for Lennar. But moving into Global Urban Village, as you mentioned, we focused on capacity building and impact investment, primarily focused on the early stage entrepreneurs with innovations that are really trying to create solutions to rapid urbanization and climate change. And geographically, we focus on Southeast Asia. It's young, it's booming, it's diverse, culturally rich region, but it's also, urbanizing at a rapid clip. So an example of some of the work that we're doing is recently we joined forces with Habitat for Humanity and Vilgro Philippines to launch the Shelter Tech Accelerator in Southeast Asia, which is currently open for applications. The purpose of this accelerator is really to find and support entrepreneurs that are working to improve the livability and affordability of housing for low-income families. If you look at it globally, there's 1.6 billion people worldwide that lack adequate housing. So Habitat's really made this ambitious goal of trying to put affordable housing as a top impact investment sector. Which there's, especially on the equity side, there's some ground to cover. So with that in mind, I thought it would be interesting to talk with Arun, an impact investor that he's comes from outside of real estate, to learn some lessons that could possibly be applied to housing. So Arun has graciously agreed to do this talk, and he's been working in venture capital and private equity for many years. So I'm excited to pick your brain, Arun. So before we get into dive into the topics, maybe you could just tell us a little bit about your background and some of the work you do at Bamboo Capital.
Sure. Thank you, Ian, and thank you for having me here today. Nick was kind enough to give me an introduction, but maybe at the risk of repeating myself here, I've been in the impact investing space for now about 11 years, working across sectors and across asset classes, largely been focused on Asia, looking at investments in early stage impact enterprises in financial services, healthcare, education, agriculture, etc. I started my career with Unitas Capital, which is an investment bank helping social enterprises raise capital, and then moved to an impact fund called Log Capital, where we largely invested in financial services and healthcare. I then moved to Bamboo back in 2016, but between Log and Bamboo, I actually took a step out of investing, or took a break out of investing rather, and joined a social enterprise called Forest Health, which is a healthcare device manufacturer based in India, to head out a new business vertical for them. I believe that for any successful investor, and specifically so with impact investor, you need to have on-ground operational expertise, which is best acquired actually working for a company and trying to build out a business. So that's what I did in between my Log and Bamboo stint. And with Bamboo, I'm currently fund manager managing one of our existing funds called Oasis, which is Bamboo's non-financial services fund, the fund from which we made our investments into sectors such as healthcare, energy, agriculture, and so on. I'm currently in the process of fundraising for a new fund in partnership with United Nations Capital Development Fund. This is an SME debt fund which will invest in early stage SMEs across emerging markets. It's a global fund. The good news is that the fund is incorporated as of last week, and we already have an initial capital commitment which is expected to come in a month's time. So hopefully towards the end of this year, we will start investing into SMEs in some of these markets. So that's quickly a background, but about Bamboo as well. Bamboo has been a pioneer in impact investing, started in 2007 by Sean Phillip, who was a co-founder of Blue Orchard, which was one of the early investors in microfinance. Bamboo currently manages just over $400 million across various asset classes and various funds. But the key focus for us so far has been largely in financial services, clean energy, and healthcare and agriculture.
Fantastic. And recently, Bamboo has gotten involved with the SDG 500 fund, which is first of its kind blended finance. I thought before we get into the sectors, it would be really interesting to hear kind of how that fund is structured and really how that structure catalyzes more investment.
Absolutely. So Ian, financial inclusion has been one of the early sectors that most impact investors sort of tackled, right? And
right.
in microfinance, a lot of investors have had success, largely because these are sectors and business models where you can invest within a private equity venture capital fund timeline and be able to exit. But when you look beyond financial services, such as healthcare, and I'm sure that's the case with affordable housing as well, you really need patient capital. These are really nascent sectors that still sort of struggles to find private capital inflow. And a blended finance structure is something which we believe works best, where extremely patient public or developmental capital can sort of act as a first loss protection to the fund, wherein private capital can sit on top of that. So what that would really mean is that instead of raising all the LP capital, the investor capital into the fund into a single asset class, we raise them in multiple different asset classes, starting with the first loss piece and then senior tranches on top of that. And the water flow at the time of return generation is such that the senior tranche investors receive their capital and returns before the first loss capital does. So the first loss investors sort of act as a guarantee or a protection to the senior tranche investors. So this is a such structure we have seen is sort of win-win, a true public-private partnership, because for the public sector investors who are not really looking at generating returns, but are looking at how their capital can be more catalytic. Or in other words, for every dollar that they invest, how can they attract more capital, more private sector capital to the solutions that they want to tackle? In the funds that we have structured, we are targeting about $4 in private capital for every $1 that we generate in the first loss capital piece from public sector investors. And from the private sector perspective, the benefit is very clear. Their capital is more protected. So their risk perception really changes and make the sector and the business models more attractive for them to consider investing into these funds. So that's the blended finance structure with which we are now raising our new generation of fund, including the Build fund that I just mentioned, the SME fund in partnership with UNCDF. Similarly, we have 5 other funds which we are in the process of fundraising for. Just to give an example of a couple of them, one is a gender lens fund focused on Southeast Asia, investing in companies which largely either employ or cater to women. This is a fund in partnership with CARE International, a large NGO based in the US working in the gender justice space. Here, CARE is helping us with raising the first loss capital piece. Similarly, we have other funds, an agri fund for Africa. We have a tech for impact fund for LATAM. All of these funds, the 6 of them, address various different SDGs and have various different geography focus. And we realized that to make it more attractive to large private investors for whom smaller funds are still below their appetite or their ticket sizes, it made sense to sort of aggregate all of these various funds into an umbrella structure. And that's sort of the genesis of SDG 500. The terminology SDG 500 really coming from the fact that the structure addresses various SDGs, and 500 because aggregated is a $500 million opportunity.
Right.
We are now actively raising capital for the structure.
Fantastic. And like you said, it really helps with the patient long-term investments. In particular, I think with the public side going in for that first loss tranche, there's a lot of benefits that come out that are, not necessarily financial, right? So, and one of the things, one of the sectors I think is really evident is healthcare. And so I kind of wanted to dive into that because I see some similarities with the healthcare sector and housing. If you think about it, they're huge markets. They have a lot of established players, really capital intensive. You got, long lead times, a lot of regulatory environment, different business models and whatnot. So, when you're looking at making these investments and finding these entrepreneurs with the solutions and innovations that are going to provide the impact that you're looking for. I wanted to see what do you really look for in an entrepreneur that can actually what do you identify that shows that this entrepreneur is going to be successful in this type of environment where you really are kind of up against a lot of big hurdles that you have to get through. In similar ways to housing. So just wanted to get your thoughts on that.
Sure. Indeed, healthcare is a great example of a very capital intensive business, a sector which has largely been based on brick and mortar businesses, which have long gestation periods and its own challenges, therefore, in terms of margins, payback, and also from a private equity venture capital perspective, therefore, the timelines for you to invest and be able to exit and generate returns. So what we have sort of seen work in terms of investable models are those that really utilize technology. So technology that can provide value-added healthcare services at the point of care. So sort of catalyzing the existing infrastructure that's already out there in terms of healthcare services and how you can provide value-added services on top of that. And ensuring that that's done at scale and in a sustainable manner using technology. So that's something which we believe sort of works well. Indeed, there are various nuances to that. There's no one single solution that works across markets. Although challenges might be similar, solutions need not necessarily be. For instance, when we invested in primary care and associated technologies in healthcare, we realized that in India, we had to consider a very different model as compared to Indonesia. In India, our investment is into a chain of primary care clinics where we provide value-added services in terms of pharmacies, in terms of point-of-care diagnostics, etc. Whereas in Indonesia, the health-seeking behavior was quite different, especially in rural Indonesia. Patients have a tendency to actually go consult with the pharmacist as opposed to a doctor. So it made sense, therefore, to really institutionalize and empower the pharmacists and pharmacies and be able to provide value-added services there by providing them with visiting consultants, providing them with technology at the point of care, etc. So those are certain nuances that one needs to consider when devising these business models. And beyond that, I think to a question of what we see as a success factor is really technologies that are not developed in silos or in a lab, but that are really grounds up. Because as I mentioned, these nuances get really, really complicated when you go down to the ground level and try to make your solutions work, be adaptable, and also be scalable. and each markets work very, very differently. And just to sort of give an example of that, we had once invested in a healthcare firm, and we're partnering with a solution provider that was working with an iPhone-based technology application that can be used to do eye checkups, so ophthalmic diagnosis. Now, it's extremely cost-effective. It's highly portable. It's just a phone, so a technician go to rural area and really carry it with them rather than carrying an entire ophthalmic device with them. Now, despite all the benefits that it had and reasonably great accuracy as well, it found very little patient or customer adoption. And when we did follow-up surveys, we realized that for the patients, a camera-based testing, where a camera is sort of thrust upon their face to take a picture, seemed very amateurish. They might not have necessarily had formal eye care access earlier, but they had enough awareness either through movies or the pictures or newspaper that they have seen that people who get eye checkup done really put their chin on a device, and there's a large device, there's a doctor on the other side. And for them, a camera seemed less medical or clinical, so to speak. So these are nuances which you only understand when you are close to the ground, really understanding the customers, sort of the market problem, and then design the solution accordingly. So that's something which we really look for in an entrepreneur as well, who really has the pulse of the market, understands the solutions, understands the nuances, and therefore develops technology and customizes it on the basis of that.
Yeah, I think, not to oversimplify everything you said, because that was really informational. I think it all kind of boils down to context. It makes me think of an experience I had where, I was tasked with managing a construction innovation startup company. And frankly, when I joined, the writing was already on the wall. And it was a really cool innovation. It had to do with concrete tilt up and doing these steel studs with clips and these things. And it really was a fascinating and cool construction innovation. But in the real world, it just couldn't get any traction. There's a lot of regulatory testing that they had to go through. There was issues with, the collateral for financing. There was problems with how to deal with insurance. A lot of different things that, as an engineered product, it was really cool. But once you got into the real world and all the loopholes and issues that you have to deal with to actually get something to market and actually make it viable, they just couldn't get through it. And unfortunately, it was too late by the time I got there. But it was a fun project and learned a lot, around a lot of what you're saying. Which, I think for, an investment, you want it to be successful. And for an impact investment, you want it to have impact. And I think the big differentiator with impact investments is that, similar to, tracking financial returns, you also track the impact returns that you receive off of your investments. And so, with your experience in financial inclusion, investing, I wanted to just touch on, how do you go about, measuring and tracking, the impact of these investments, in particular, because you need to report that. You need to, as your own business, be able to meet or exceed the metrics that you've put forward in your fund. So can you talk a little bit about how you go about and how Bamboo goes about tracking and measuring impact?
Absolutely. And I think as an impact investor, it's beyond reporting as well. I mean, impact is at the core of what we do as an organization, and also as individual investment professionals. I can say that I'm yet to meet an impact investor who's not really passionate about impact that's being generated, right?
Yeah, definitely.
So I think, across sectors, we have various different metrics that we look at. There's indeed a base layer of basic parameters that we do measure across sectors, such as outreach, so the number of clientele that you reach out to, especially looking at also, to the extent that's possible, their demographic profile as well, looking at the employment that's being generated, looking at the sort of the gender breakup of both the customers and the employment that you're generating, etc. So those are the initial sort of outreach, or rather I would call it the hygiene impact factors that we measure across all our investments and all our sectors. But beyond that, it's really looking at very sector-specific metrics. So in financial services, one such metric would be the savings percentage. In energy services, a metric would be, in fact, the amount of expense that they have on utility on a monthly basis, or therefore the reduction or the savings that they incur after utilizing your service. In healthcare, we do sort of baseline end-line analysis in the geographies that we operate in. Or even do specific customer outreach surveys to understand the benefit and the impact that the services have had. So these are sort of direct impact that we measure. But in all these cases across business models, there are several different indirect impact as well. For instance, if you look at employment, when we invest in SME, there's a direct employment that's being generated and sustained, both. Existing employment being sustained and new employment being generated. But most SMEs work in a very complex and very well integrated supply chain. So it's not just employment generated within the company, but also through the supply chain. So to be able to measure that as an impact of our investment, that's something which we do. Another aspect that we look at is, especially in financial services, though most companies that you would see impact investors investing in are lending organizations, there are a lot of them that do provide savings products as well. But more importantly, seeing how the financial awareness of the customers have changed over a period of time. This can be measured using how their savings percentages have increased. It can be measured looking at their customer journey. So customers actually initially taking up more immediate income generating loans for their agricultural needs or their SME needs, and then slowly moving to education loans, housing loans, which are more longer term. So really understanding whether we are creating a financial roadmap alongside the customer, that's really measured through indirect impact metrics, which might not be as exhaustive as the direct metrics, so it might need more on-ground presence, specific surveys and research methodologies, but that's something which we do. And it's sort of linked to my earlier comment on finding the right solution that works for the base of the pyramid, because what's really important here also is when you design a solution, it's a very fine balance between finding the right cost-effective product or solution, and also that solution being, or rather meeting the aspirational needs of the customers. So it has to be a fine balance for that to work and to have the right impact. And I believe that's even more relevant for housing, because you want to make the price points really work for the market segment. You want it to be sustainable, a good payback period, but at the same time, it's a house, right? So for the customer, it has to have the aspirational needs have to be met. So it's always a fine balance between that, and these impact metrics really also help us assess those.
Yeah, definitely. I think, particularly when you think of impact with housing, it's not just putting a roof over somebody's head. It's about having dignified housing. It's about having adequate housing, and beyond just, having, the warmth and safety of a home, there's so much additional impact that comes out of it. A lot of research shows, things like child development and health and improved quality of life, overall just healthier communities and increased economic activity all come out of having quality housing for everybody. And so, I think it's really critical, particularly with the, tracking and measuring of the impact of things like housing or healthcare or financial services, is to show really what that multiplier effect is that comes out of that investment.
Absolutely.
Yeah. Okay. Well, I think we're at the end of our time here. It's been a great conversation. I really appreciate it, Arun. Nick, I don't know if there's any questions or if.
Yeah. I haven't seen any questions so far. So if anyone in the audience has questions for Arun and Ian, feel free to either drop them in the Q&A or the chat box, and we'll make sure to get them to them. I actually have a philosophical question about impact investing. I'm curious, how do you, so when you all make an investment, and I guess this question is mainly for Arun, let's assume the investment does like super well. So it's like, let's say it's a 100x, it's a home run, but there's like very little evidence that it actually had the impact that you wanted. Do you consider that a failure? And like, how do you judge investments based? Like, how do you account for the balance of strong impact versus strong financials?
Sure. So Nick, I think, and I fully sort of appreciate that question, because that's something which we often hear from investors. The whole question of how do you balance impact and financial metrics, and what if one ends up receiving more of an attention from the investor, right? In practice, though, that's hardly ever the case, because when you invest in an impact business model, and let's take, for instance, an affordable housing company, the technology that you have, the business model that you have, is very, very customized and specific to the target segment that you are working with. People at the base of the pyramid, just to sort of oversimplify the market profile. It's highly unlikely that you would end up focusing on another segment a few years down the line. The so-called impact shift is very, very unlikely to happen. Mm-hmm. And this is the case with any sector. A microfinance organization cannot in any way tomorrow start operating in cities and sort of catering to high net worth individuals. The business model is not structured to do that. Mm-hmm. So as long as there is no mission drift, they are still within the same industry. They are still catering to the same segment that they started off with as their impact thesis. The only way that they can receive a 100x return is if they have been extremely successful on the impact metrics as well. That is, they have been able to successfully cater to those target segment customers, have been able to scale up within that segment, and really provide more value-added services to that segment. That's the only way they can receive a 100x sort of return, in which case we have succeeded in impact as well.
Okay, gotcha. So there's some nuances to actually how you, when you define a sector and approach it, just the nuanced work of what it's going to take to get an investment to 10, 100x in a space is going to lead to the sort of impact that you want to define. Yeah, makes sense. Cool. Well, great. Well, we're out of time, gentlemen. Thank you so much for your insights and just your thoughts and ideas. I thought this conversation is, it's interesting because this is a subtle thread throughout all of our conversations that we've had over the last 2 days. The concept is innovation to save the planet. So there's impact investing happening, across the board in any technology, we're looking at. And talking about. So very, very cool to, I think, towards the end of the conference to kind of tie this together with your work, Arun and Ian. So thank you so much for joining us. Audience, if you have any questions, again, for Arun and Ian, feel free to drop them in Slack in our Shadow Summit channel. And I'm sure we'll be able to share any further questions if you have them, either for Brian or myself. We can pass them along. So feel free. Thank you again, guys. And we'll actually be back in, I believe, 30 minutes for our next discussion. And so, yeah, we're going to take a quick break. Thank you again, and look forward to seeing everyone soon.
All right. Thank you very much.
Thank you.